All right, we got a big day of earnings over the last 24 hours. So a lot to go over. We're going to cover the obvious one that I think everybody's talking about today is Tesla. And then we're going to cover Mastercard a little bit later. And then Las Vegas Sands, which I think is an interesting company in the entertainment and gambling space in Asia specifically. I think this could be a really great growth area, and this is kind of a bellwether for that region. So I asked Jason Hall from the Smattering to come on. Jason, how are you doing this morning?
I'm good. I'm good. These are going to be some fun ones to talk about.
Yeah, absolutely. And if you haven't already, please follow me at Rive Investing here on YouTube, at Travis Hoyam on Twitter, and then Jason can be found at The Smattering on both of those, and he has a podcast as well. So listen to that. Let's go over the high numbers for Tesla, and you can kind of jump in here. I want to go into like unit economics in just a second, but we can kind of talk about where the trends are heading. Revenue was up 33%. Gross profit was $5.5 billion on a gross margin basis. That was actually down 466 basis points, so almost 5% from 30.6% a year ago to 25.9%. So we're starting to see some margin pressure there. One of the things I was really impressed by is Tesla has, I think, kept its operating costs under control better than like any company that is related to the state of California. Um, and that's giving them the operating leverage that even though gross margins are coming down, they are increasing volumes. So their profits are actually going up slightly, um, up, I think it's 43% from a year ago to $4.1 billion. Those are kind of the high level numbers. What did you see there, Jason, that you want to comment on?
So, a couple things that you mentioned there, I just want to kind of circle back around and add some color to, and we'll talk about a little bit more. But I think there's so much focus right now on the price cuts, and we haven't seen those in its reported numbers yet. I think that's the really important thing to remember. Is
What
what
we
we're
have seen is the discounting they did in
well,
numbers that
December, right? But we haven't seen the more
yes,
recent,
right, correct,
right over, and we certainly haven't seen anything over a full quarter, right? So I think
right.
that's really important context people need to consider when they're looking at the numbers and thinking about the results. But what we are seeing is the impact of price increases from earlier in the year, right? That still provided some economic benefit in the quarter. And the other thing I want to say is that I think broadly, Tesla's price cut strategy, whether it's a strategy or just a reaction to demand, is debatable. And I think it's probably a little bit of both. I think it makes sense because this is still at a time when you want to be grabbing market share and grabbing it profitably. And if you can kind of toe the line on those operating costs and find like that sweet spot, then I think it can be a healthy move for the company. But investors need to be realistic that cutting prices is not pricing power. Being able to cut
No.
prices while still kind of towing the line on profitability is a cost advantage. And maybe Tesla has that. And this is the big question I have over the long term is how long is it going to maintain a cost advantage as companies that have decades of experience manufacturing cars and have the established relationships with suppliers kind of leverage their muscle
Mhm.
with those suppliers and start building their own cost advantages.
Yeah, I think that's right. I'm going to share a little presentation I put together that hopefully puts a little bit of context to exactly what you said, because I think the right way to think about Tesla right now, they are prioritizing volume growth over profitability. That was almost explicitly said in the conference call. And this is what I mean. This is their unit deliveries. It's on a trailing 12-month basis, and they basically said, I mean, this is the target that they set for themselves: grow volume 50% per year for the foreseeable future. I don't think they put an end date on that.
Yeah,
Um,
and the key here is that's not 50% every year. It's a 50% CAGR. We are seeing the
right.
rate of growth is slowing down.
Yes. So they are, but they are planning on getting to 1.7, maybe 1.8 million vehicles in 2023, which is a big number. And now suddenly you're playing in the world of That's about how many vehicles BMW makes.
Right.
So these are really big numbers. I just pulled this is the revenue per vehicle, and I pulled out the credits that they get from other automakers, the renewable energy credits, because that's not really sustainable. That's not part of their pricing. It's not a sustainable revenue source, although it's lasted a lot longer than I thought it would. But I think as these other companies increase their production, that will probably go away over the next couple of years. They did have some price increases that hit in 2022, first half of the year specifically. If you were, the auto market is still under a really tight supply situation. Tesla has been able to make more vehicles more readily than most automakers, but most
They're kind of, their
companies,
integrated model actually kind of paid off a little bit.
yeah, and the fact that they're a more advanced company from a technology standpoint. I mean, they're not
Right.
using the old legacy chips that a lot of the other automakers are. And so that allowed them, if there's no vehicles on any lots and you can supply vehicles that people can get in a reasonable amount of time, well, you have pricing power. So that pricing power was put into effect in 2022, specifically in the first half of the year. But it has come down. The average sale price. Now, what's a little bit difficult in their numbers is that they do have those high-end vehicles like the Model S and Model X, and then the less expensive vehicles like Model 3 and Model Y. So this is a blended average, and I looked at the numbers and they're ballpark about the same from a mix perspective, but it's not an apples to apples, not necessarily 100% the same vehicle. This is what I think was interesting, though, is the gross profit per vehicle is starting to come down, and that has actually been consistent over the last year. Like you said early on, before the price cuts of up to 20% that happened in January 2023, this does not include any of that. It does include some discounting that happened in December, but that was a much smaller number. So keep this in mind, because Tesla can grow volumes at 50% a year, but if they're making less profit, gross profit per vehicle, that means that their earnings may not go up at all as a result. Anything you wanted to touch on here before I get to the next section?
No, I'm gonna be Charlie Munger here. I have nothing to add.
So here's what has happened over the last few months. Discounting started in early December, $3,750, and then that was increased to $7,500 by the end of the year. Also keep in mind that over that time, over the third and fourth quarter, Tesla added 55,000 vehicles of inventory. So it made 55,000 more vehicles than it sold. That has reflected the company's the a balance sheet. The inventory of those vehicles
Right.
is on the balance sheet.
This is historically, this hasn't been something Tesla has done a tremendous amount. It's found itself at the end of every quarter scrambling to deliver cars to be able to recognize the revenue, and ending the quarter with surplus inventory. This is how do we analyze it, Travis? There's two ways to look at it, I guess, right?
Yeah, and to get to the inventory number, just to have that number here, $5.7 billion a year ago was their inventory. The end of last quarter, $12.8 billion.
Yeah.
That's a big increase. I have done videos on inventory. I've been writing about companies that get in trouble because they build too much inventory. What you end up having to do is end up having to lower prices. Elon Musk said this during a conference call, because they were talking about the price reduction that they did in January, and they said we have just a ton of demand. We've had more demand today than we've ever had for our vehicles. And so he said, so basically, price really matters. As somebody who is questioning how profitable this company is going to be in the future, I hear that and I say, yes, because the laws of supply and demand are real. This is the Econ 101 supply and demand chart. This dark blue line is demand. Demand goes down as price goes up. So as Tesla increases their supply, which would be this light blue line, in theory, they would have an equal amount of demand at a lower price. That's what supply and demand would tell us. So if they want to have charge $100,000 for every vehicle, they maybe can only make 50,000 vehicles or 500,000 vehicles per year. If they want to sell 5 million vehicles per year, well, now you've got to reduce your prices to maybe $30,000 per vehicle.
Thinking about the automotive industry, we're talking about the difference between a Ferrari and a Volkswagen. If you were to look at the two opposite ends of the spectrum, right?
Exactly. So the challenges that companies always have is trying to find this balance point where you don't have excess
and it's different
supply.
for every company.
It's different for every company. It's different for every product. Any company that is making a product, especially a physical product, this is the challenge. This is the name of the game. This is why Tim Cook is the CEO of Apple, is because he was brilliant at this. What these two lines here are is the green line is what you can charge in price, and then the red line is your cost. Underneath the green line is your revenue. And between the two, this is your profit. So now I didn't make 15 charts for this, but you can imagine that if you go down this supply curve and now you have to reduce prices, now suddenly your profit per vehicle starts to go down. In a worst
case scenario,
to
find the sweet spot where you can generate the most dollars of profit per unit of revenue that you generate, right? Because you can increase that gross profit up to a point by increasing the price of the vehicle, but it's going to reduce the number of people that are going to buy your product, right? So that's the balancing point. That's the tipping point right there.
A Bugatti, let's say, you can make one Bugatti and make $1 million in profit. Maybe you make a Volkswagen and you make $1,000 in profit. But if you
can sell a lot more Volkswagens than
you're making less
make
profit.
Bugattis. Right.
Yeah. So it's a balance of figuring out where do you maximize profit. And what I'm arguing here is that Tesla and Netflix did the exact same thing last week, is saying that we are trying to increase our volume over maximizing our profit. And I think that's where
it's cutting margins to increase margin dollars.
Theoretically.
Right.
But this doesn't last forever. And the other thing that's always difficult in a manufacturing business is the fixed costs that go into it. This is not software.
Right.
And then that plant exists. So if you
all of the costs to keep that
all
plant
the costs
at a minimum
associated
state of operations, they exist.
So if you have 5 million vehicles worth of supply as they build out more and more supply in Texas and other parts of the world, now you have 5 million vehicles of supply. If you start running that plant at 3 million or the aggregation 3 million unit run rate, you're going to be less profitable than when you were running full tilt. This is always the hard thing to get your head around when you go from being a growth company and the unit economics just sort of working for you because you're always at full capacity, to now we got to balance supply and demand. We got to figure out, well, when do we need to build that next plant? It's not as fast as we possibly can. It's maybe we build it in 3 years.
Right.
And I think that's where we're at with Tesla, is making this transition to now we have to live by the laws of supply and demand. And it turns out we don't have infinite demand at the pricing in Q2 2022. How much demand is there for the pricing in Q1 2023? It appears to be that there's a lot of demand. What happens to margins as a result of that? I think it's already clear they're already going down, and they're going to go down probably pretty significantly in 2023. Tesla continues to ramp, continues to be on that charge to increase production 50% per year. That is a massive increase at their current scale and in the auto business. So that was a lot of stuff. I mean, anything you want to kind of recap there, Jason?
Yeah, I have a few kind of closing thoughts on this. And number one is, I don't think Tesla's growth days are over, right? Like you said, a year from now, assuming all goes well, right, according to plan, it's going to be about the size of a BMW in terms of volume, right, of vehicles. And BMW is a big manufacturer. They make kind of a middle upscale product for the most part. So I think that's a pretty good comp, but that's not what Tesla's aiming to be. Tesla's aiming to sell Volkswagen numbers, right? So making less expensive cars makes sense, but there's a difference between making less expensive cars and cutting prices, right? I think we should really, really remember that is if you want to make a less
Right.
expensive car, you have to build a car with fewer features that's a lower cost, not just cutting costs on your more expensive to manufacture products, right? So you have all of those things that kind of come into play. I've said for a long time, and I want to circle back to the Netflix part in a minute, but I've said for a long time, the key with Tesla is how long can it grow at a rate that kind of neutralizes the typical automobile industry cycles that we go through.
Mhm.
And I think this year's going to be a real proving ground for me for Tesla and its ability to outgrow the cycles, because at some point it's going to be at a scale where its growth rates are going to slow and it's going to normalize. And then it's really going to be subject to not just the supply and demand aspects of it, but the cyclical aspects of how that demand can change very quickly. And you have to be nimble and ready to change with that demand, or your highly profitable business at scale, because of those high fixed costs, can be a big money loser. And sitting on 50,000 cars in preparation of the next quarter, and then that demand isn't there, well,
Mhm.
guess what? Your fixed costs are higher now because you have to store those cars, you have to maintain them, you have to do all of the things necessary to protect that economic value. And for most automakers, that means you cut the prices to try to move them out as quickly as you can, right? At some point, Tesla's going to be subject to those same things. What we don't know is how quickly that's going to happen and whether or not all of the other things that are part of the Tesla thesis that are baked into its valuation, Travis, self-driving, all of the high margin revenues from autonomous fleets, and all of these things, these great ideas that haven't materialized. We don't know if those things are going to be actual revenue generators when this is a mature automaker. And I think that's a real threat to the valuation that investors need to be really thoughtful about.
Yeah, I agree with everything you said. And the other thing that I want to add to this from a demand perspective is I think that we have been in a state for over 10 years now where Teslas were in incredibly high demand,
And
and
there was not a competing product.
there was not a competing product, and it was cool, and it was new. There was a price premium. That price premium is slowly but surely evaporating. Um, go look at the Volkswagen ID4. It's pretty much the same price as an internal combustion engine in vehicle. The I think that's going to be a really interesting transition for them to make, as a lot of these other automakers bring really compelling vehicles onto the market. I've been impressed with
Yeah.
everything the Volkswagen has done. I've heard good things about Audi's vehicles. This isn't just $100,000. This isn't just Lucid and Porsche coming into the market. These are really big players that are actually starting to make some numbers. Ford with the Mustang Mach-E.
Mm-hmm. Mm-hmm.
Um, Not everybody wants the same vehicle. I was driving around. We're looking for a new vehicle, and I was talking with my wife about this last night. And it's interesting. You drive around, and you can go in and look at a certain vehicle, certain brand, and say, "Wow, that costs that much money. That makes absolutely no sense to me." But it makes sense to somebody else.
Right. Right.
And Tesla makes four vehicles that essentially look the same, and they've looked the same for 10 years.
It's two vehicles with four badges, I think, is the better way to think about it almost.
Yeah. Yeah. So the car buyer going in to look for a new vehicle and look for an electric vehicle in 2023, do they look at that Model 3 or that Model S in the same way that the person who was buying the same vehicle in 2017 or 2018 does? I don't think so. There's a reason that automakers refresh their vehicles every 7 or 8 years, because you want to be cool and have the new thing, and people don't want to have. I
Well, it's
mean,
fatigue, brand fatigue. It
it's brand
happens.
fatigue. I mean,
Yeah.
the Ford Taurus like an amazing looking vehicle and super cool when it first came out in the mid 90s when they did that brand refresh.
Right.
If you
Right.
bought that vehicle today, you would look ancient.
Right. It would
And
look as if you bought the Taurus from the 80s, right? That's
yeah, and I think this is the part that we're moving into this more mature phase where Tesla is going to have to live by the supply and demand, like we've talked about,
Mhm.
and the whims of the customer. And I don't think Teslas are all over the place now. Even I live
Yeah.
in Minnesota. There's a bunch of them within a stone's throw of my house, and I think that's gonna be a sort of a drag on them from both a pricing power standpoint and from a demand standpoint because they're not the only game in town anymore. So we're starting to see, if your thesis is like mine, that this gravy train of high revenue or high margin sales is going to go on forever. I think we're already starting to see that break. We will
Look at
see
what's
how,
happened to Netflix. I think that's a reasonable comp in terms of a company that was massively disruptive, found a niche where there was gigantic demand, and then just owned it for a decade and was very profitable and made a lot of smart investments to scale up and grow along the way. But now you have all of the other vested interests that you've been disrupting that are now looking at your market, and it's not going to be as easy. It's not going to be as easy.
yeah. This is going to be a really interesting one to watch in 2023 because I think the trends of the last decade are going to change. I don't know exactly what that means. I think that we can both agree Tesla has a different business model and probably a business model than the legacy automakers.
No
It
doubt
is
about it. No doubt about it.
it is going to have premium margins for the foreseeable future. I don't think we're going to them reporting a 8% gross margin. They've done a really good job controlling operating costs. They have all these opportunities to add really high margin features like self-driving and things like that. The question is how profitable is this company going to be in 4 or 5 years, and what do you want to pay for it as an investor? I think that's what's
Right.
challenging right now. Is we've talked about a few companies within earnings season. There are companies where you go, hey, maybe the future isn't quite as bright as the last 2 or 3 years, but I'm getting a really good price.
Right. Right.
This is one where I go, maybe the future isn't quite as bright, and I'm also paying a really, really, really high price. And that's where
Right.
it sort of breaks my brain. Anything you
Yeah,
want to add
I'm with
before
you
we?
there. I love the business. I really do. What the company has done is incredible for the world. It's making the world will be better for my 6-year-old son in 20 years for what Tesla has done. I don't want to own the business because I think there's so much risk about everything you were talking about what can it possibly be versus what is it actually going to be, and the price you're paying for that future that's already baked into today's share price.
Love the company. You can love what Elon Musk is doing and not love the stock.
Yeah, there you go.
All right, let's move on to Mastercard. You want to walk us through that one?
Yeah, I can do that. So I'm going to start with I want to share a slide from the press release. Give me just a second here to pull it up. So this is from the press release, and this is the full. You see that right there, the full year operating results. So a good year. Revenue on a GAAP basis was up 18%. Mastercard, a very international business, right, with revenues generated in every denomination of currency, just about everywhere in the world except for Russia now, of
They're more
course.
international than Visa, right?
Yeah, sort of. I mean, their business mix is a little different, right? And they've really focused on like the business to business payments and some other like cross border stuff. So they've done some really smart things in that way. But again, the key here, right, is that currency neutral, right? We look at that gap, and this is when they take all those foreign currencies, and we know the dollar's been crazy strong this year, and you adjust them to US dollars, and it's 18% revenue growth. But on a currency neutral basis, 23% growth. That's great. This is a real positive when you see operating expenses are growing at a much slower rate than revenue. This is the key to me for a company like Mastercard. This is where you get that operating leverage, where your operating income is growing at a significantly faster rate than your revenue is, right? That's the absolute key here. Now, here's the thing though, right? You look at net revenue was up 18% and the net income was only up 14%. So there's expenses that are happening that are not necessarily great for the business, even on an adjusted basis. Of course, like always, they find a way to make it look better. I will say that by and large, Mastercard's adjusted expenses aren't as egregious as some of the other companies that we look at here. So let me do this, Travis. I'm going to jump back over to their presentation, and I'm going to walk through some numbers again for the quarter, just to kind of break down what's going on. Because the best way to describe it is, again, you go from 18% revenue growth for the year to 12%. Now this is adjusted, but their non-GAAP revenue is the same as their GAAP revenue. That's not adjusted at all. So that's good to know. So again, revenue growth is slowing in the quarter. Adjusted operating expenses, again, the adjustments they make are relatively minor, and it's the same adjustments they made this quarter to the year ago quarter. So they're apples to apples. Again, you see it growing in the quarter. Operating expenses grew at not that far from the same rate as revenue. It looks a little better on a currency neutral basis, and that's important because that's going to ebb and flow over time. The reality is a few years from now, the US dollar could be weak against like the euro, for example, which is a really important currency for Mastercard. And all of a sudden that operating leverage really, really pays off. The key is that it's just not quite what we've seen in the past. Want to break down the growth rates. So a couple things. So you see these percentage for gross dollar volume. The percentage, again, these are in currency neutral, local currency rates, right? So we see consistent revenue growth around the world, and it looks at the surface like, well, that's not that different than what we're seeing from inflation. But when you start looking at like transaction volume, it's like, okay, you know what? The growth story still looks pretty solid. So switch transactions, MasterCard and Visa, basically, they kind of serve the same purposes. Like they're the rails that connect. So think about like shipping, Travis. So you've got container ships that bring these big containers in, and then the containers get put on a train, and they run the train, and then they take that container and that intermodal container, and they put it on a truck, right? And then the truck takes it to the distribution center. MasterCard's like those rails that connect those other systems, right? And the other systems in this case are merchants and banks, right? Merchants and financial institutions. So switch transactions is the rails, right? So again, number of cards increased 5%, transactions increased 8%. That's great. When that means that not only there are more cards being issued, but there's more transactions are growing at a faster rate than card growth. That's a real positive for the business. Now, another thing that's really important, again, we keep talking about it. You talked about how this is a very international business. Cross-border volume continues to grow at a really high rate. Again, I think that's just a tailwind here because it's nothing I don't think that Mastercard's specifically doing besides focusing on having the tools to facilitate those sort of transactions. But it's just a reminder the world's opening up, right? And then we're returning to more normal travel patterns, which is going to drive cross-border volume. They're still showing this comp to 2019. Travis, this was really useful early last year and through all of 2021.
Yeah.
Because 2020, the world shut down, right?
Right.
So it's a healthy metric, but I think it's becoming less and less important. And I wanted to just briefly talk about those pre-pandemic comps are becoming a little bit less useful. Let's look forward, Travis, what they're saying for the full year. So they made some comments about it, but I think this is useful because we just see low teens, right? This is their forecasted growth for the full year. And again, this is getting back to that healthy numbers, right? We saw operating expenses growing, I think 10% versus 13% growth in revenue in the quarter. Just in it, they're saying, well, we're going to get low teens growth and mid-single digits growth in operating expenses, right? So that's that operating leverage that we want to see. Now, and this is the full year. First quarter, high end of high single digits, so like 8-9%. mid-single digit operating expense growth. So we're getting the operating leverage, but the revenue growth is going to be, they're expecting it's going to be even slower than it was in the fourth quarter before ramping up later in the year. And that feels pretty optimistic to me, but they're kind of backloading it. And
Is
go ahead.
no, there's a couple of trends going on here, isn't there? So there's the opening up, there's people spending more money, the continued digitization, which effectively means just using credit cards as the rails instead of cash or checks
Right.
around the world.
Inflation, that while consumers are still spending, right?
Yeah. And then they also had price increases that went into effect last year, didn't they?
Yeah. Yeah.
So it's
Right.
kind of all these things hitting at once. You think about Mastercard being a pretty mature business, so growing at this rate is pretty impressive. But there's a lot of pieces going into it.
There are, and it is a very mature business. And here, yes and no, because as mature as it is, it's a mature business in a still growing industry. I think that's the key thing about it, is that on a global, in the Western consumers, particularly U.S. based consumers, are very biased to, whether it's the card, right, or whether it's the phone as the card. We use them to pay for everything, right? We pay for
Yeah,
everything with plastic, and that's certainly not the case in a large part of the world. But it's becoming increasingly so, particularly because of things like smartphones,
yeah,
where a larger cohort of new middle class consumers they're going straight to digital transactions, right? Using a device to make that payments and not using paper money. But the big thing, Travis, is business to business is still an enormous opportunity. Think about like government payments, and again, just the business to business transactions is still largely paper checks. It's stunning how much of that is still hasn't
it is very
transitioned. And that's where Mastercard has really made inroads more quickly than Visa. And I think it can continue being a place where it can drive a lot of growth. So as much as it's a mature business itself, I think the industry is still set for high single digit revenue growth, for the next decade, frankly, with that operating leverage that they can generate, that can really continue to make it a real compounder. But you see some risks with these kind of businesses.
Well, I think everybody in the financial space is trying to think about, is there a way to disrupt these rails?
Yeah.
Because I think
Yeah.
even a company like Apple just kind of said, hey, we'd love to not pay Visa, or they're a MasterCard, right? We'd love to not pay MasterCard 2% of every transaction, but what else are we going to do?
Right.
And so
Right.
this is one of the reasons that I've been really interested in cryptocurrency. And, I know that turns a lot of people off, but from a
Well,
real
it's the
practical,
joke, right? It's, you say it about everything. Bitcoin fixes this, but
yeah, and
I'm with you
Bitcoin
here because
specifically wouldn't fix this because that doesn't have low transaction costs. But
no,
there is a reason that big bank CEOs are very interested in the blockchain,
right,
because they see a way to disintermediate a company like MasterCard or Visa and say, you know what, we still want to keep our fees because they're part of this transaction as well,
hmm
but we want to make it lower cost for everybody and have less friction in the system. Maybe even increase the number of transactions as a result. So that means we generate more revenue. I think that's coming. I don't know when. It's not
yeah,
going to be this year. It's probably not going to be next year. But what I think is really interesting, as I think and study a lot about disruption, is what ends up happening is the disruptions that are really impactful are the ones that the incumbent doesn't have a response to.
right,
If
right,
if a cryptocurrency comes along and the transaction cost is a fraction of a penny, and that money can get from you to the merchant. Let's say you're buying a cup of coffee, and it's not going on MasterCard's rails anymore in the bank, it's going on blockchain rails. How do they compete with that? They can't
right.
lower their price to compete with a just strictly digital transaction that has no intermediating company involved. So that's where that's what I'm watching closely. We have definitely not seen that in the numbers yet. Watch companies like Square and PayPal first. One of the things you talked about that I think is really interesting is the customer's already trained. The customer can use the digital wallet on their phone. They're paying on a digital payment, tablet, even if you're using like tap to pay. The physical card isn't valuable anymore. It's just like if we were going to build this entire system now, the physical card wouldn't exist. So
Mhm.
I think that's a really interesting dynamic, that the change to go from where we are today to using different rails is so much smaller than going from checks to credit cards.
The challenge right now, Travis, is when it comes to on blockchain, is the intermediary becomes, well, you have to buy Bubba token, right?
Well,
And
not
you
that's
pay in
not
Bubba. Well, but the way that, like, the mechanics, by and large, there's an intermediate. The intermediary becomes the crypto asset, and until that becomes seamless and like the value of the crypto assets are predictable and stable, or pegged to whatever currency
Yes.
you're
Yeah,
buying and
I
selling
think
in.
it would be a pegged currency. I think all of that would
Right.
happen in the back
Right.
end. If you're talking about like a payment processor like Square, I think that your usage as a user, or even as a merchant, would change absolutely none. You would do the exact same things that you're doing today.
Right.
I
When
think
that happens, then that's where the disruption happens. And
yeah.
whether it's Netflix and Reed Hastings saying, "Okay, we got to disrupt our DVD business and move to streaming," and somebody in Mastercard figuring that out, right, in a way that doesn't kill their cash cow, that's what remains to be seen.
Yeah.
That's yeah,
Yeah, and
that's what.
Mastercard's moving into this space too.
Yeah, they
They
are.
see it.
They are.
They see it. They know it's coming.
Yeah.
So, well, that's an interesting one. We'll definitely keep an eye on that, because I'm curious about that. Not I sold all my credit card stocks last year, and I wrote about it if you want to go back and look at that one. But I see disruption coming. I just don't know it. Disruption's impossible to predict the timing. So
Yeah.
we'll see. Let's talk a little bit about Las Vegas Sands. This is an interesting one, and the context here is I'm interested in what sort of this reopening trend going on is. What's been really fascinating in Las Vegas specifically over the last 2 years is, I mean, the US was sort of locked down for like 3 months. And then depending on where you live, the restrictions were different for maybe a couple of years. But the Las Vegas Strip is reporting record gambling revenue all time. Now, basically, revenue was flat from 2005 to 2019. And then suddenly we come out of the pandemic and we take a step higher, like 30% higher.
Right.
So I think that's a really interesting trend. There's a lot of pieces there that I don't know exactly how to react to it. Is it more people doing remote work, and then, well, we got to get together once a year, so either let's do it in a place like Las Vegas where that's easy to get to, or are there's starting to be more conferences. I think that was less of a pull over the last year. It probably will be more helpful in the next year. Is it people wanting to travel more because they're working at home to
How
do some
much
of
of it
those
was
things?
pent up demand from people that
Yeah.
Vegas is where they went, just where they happen to go? Yeah.
Yeah, but it's like we've overcorrected so far
Right.
that we've almost made up for the that lost period of time. So
Travis, I know one of the things you wanted to talk about, I'm gonna kinda tee this up for you, is that I think, say what you want about Vegas, but I think unless you follow the gaming industry and these companies really closely, the average person that's watching this is like, "Okay, so there was a bunch of growth and it's just gonna be what it's gonna be." Gaming companies, and especially Sands, this is not about Vegas at all.
no, in fact, they don't have any exposure to Vegas anymore.
Right,
They sold
right.
all their Las Vegas casinos. This is almost entirely a Singapore and Macau business. Macau pre-pandemic was about 6 times the size of the Las Vegas Strip from a gambling revenue perspective. Singapore, I don't have the number in front of me, but I think there are 2 casinos there, and I think those 2 casinos did almost as much gambling revenue as the Las Vegas Strip.
Right,
Like the
right.
numbers are crazy, and Las Vegas Sands owns one of those casinos. So I'm gonna share part of
And
their
these are largely China stories too, in terms of where their customers come from.
yes, where their customers come from, and I'll show that in some of the numbers here. So here's just the high level numbers, and they do go back to 2019 for a reason. You can see here just from the revenue perspective, $3 billion in revenue in Q4 2019. A year later, it was down by 70%, and we haven't really gone anywhere since then. I think in the US, if you're a US based person, you think that the pandemic may have ended a year ago or 2 years ago, depending on where you live. In China, it is kind of just getting started. Like the COVID numbers are crazy right now, but in 6 months they'll probably be doing what we were doing in the US in summer 2022 from a getting out and going and traveling again. But it hasn't happened yet. Um, Adjusted property EBITDA, this is a number that is useful in the gambling industry because you spend multiple billions of dollars building a casino up front, and then what you want to understand is what is the cash coming out of that casino. So the depreciation in items like that are non-cash are not as important as they are in a lot of businesses, because you do want to get a proxy for what the cash flow are. So that's why this is a useful
A lot
metric.
of that depreciation is tied to the physical asset, the real estate, the
Right.
properties, which, like most real estate, tends to hold value, right? Or even gain value over time.
Yeah, yeah, exactly. So adjusted property EBITDA, $1.2 billion in Q4 2019. We're still only at 329 million. Singapore is doing pretty well again, but this is largely because of Macau. Again, here's just a visualization of that. So if you're an investor looking at these companies, and what I'm looking at and thinking about right now is, we saw in Las Vegas that when things opened up again, people went crazy. What happens in China and Asia when we go through the same cycle, but people have been stuck at home for 3 years or not been able to travel for 3 years? I think that's the trend that I'm going to be looking at. Um, all of these numbers are down. This is the mass market table win. So this would be the win per table by quarter. So just and then here's the Macau mass market business. You can just see falls off a cliff. This is they actually had their first lockdown in February of 2020, before most of us even knew what COVID was, and we still haven't recovered. We're still down from those early days. So visitation again. So the story here is not necessarily about what the quarterly numbers were, but that a company like Las Vegas Sands is just kind of bumping along. Here you go. This is Marina Bay Sands. This is the huge casino that they have in Singapore, starting to get back to decent decent numbers. Singapore did not have the same zero COVID policy that China has until recently. So this was the most profitable casino in the world pre-pandemic, starting to get back there. So, but again, we're still not there. So when I look at these results, I just see so much opportunity in 2023 into 2024 and say, where do we go from here? I think we could go to a higher high than we even had before. The other thing that has happened over the last few months is that Las Vegas Sands and the other casino operators there got an extension, a 10-year extension for their gaming concession. They are basically given the right to operate casinos in Macau, but they have to apply, and there's only 6 concessions. And I think their commitment was to invest $3 billion in properties there to expand. So this is really about a future story, but we're starting to see the thawing of the Asian market. You're seeing that first in Singapore, which we saw a little bit, but that's still down from 2019. Macau is going to be the story to me of 2023. I think this is a region that could be, it's literally a train ride away from like 100 million people in China.
Right. Right.
and
Right.
and the the amount of money that could be coming to Macau over the next year, depending on the rules, the visa rules, could be really tremendous. And I think that's going to be a tailwind for Las Vegas Sands, Melco Resorts. Wynn Resorts are the three that have kind of the most exposure, and then MGM Resorts is the other one that has the least exposure, just from a percentage of its business basis. But it does have 2 casinos there as well. So, any thoughts there, just broadly on the numbers or
Travis,
the
I've, I've
trends?
I've actually got a question. So we talked about Tesla earlier, and the delineating between loving the business and loving the stock. And my question on Las Vegas Sands, I'm going to share a chart here. Hat tip to the good folks at Y Charts. This is from the kind of the lows last year, last June. The stock is up 90%, right? It's up
Mhm.
pretty sharply. Just this year, it's already up. So I think the point is that there's a lot of investors that kind of have the same sentiment that you do. Even with looking the other way, the stock is still down roughly 28% from the pre-COVID highs. So my question is, where in the middle is, you know, the you've seen this increasing bullishness in its prospects, the likelihood that it's still going to take some time, months, if not a year, before we really get to that point, um, and what its future could look like compared to the kind of business that it was, 3 years ago. Thinking about the valuation, where do you put it?
The fact that it's still down pretty significantly from pre-pandemic, I think is what we need to look at, because like I said, the Las Vegas Strip is generating about 30% more revenue than it was pre-pandemic.
Yeah, I think it's a stock that peaked in like 2018, right?
Yeah, and then it basically became a dividend stock. I,
Right.
I've written a number of articles saying actually the reason to look at casino stocks in 2019, 2020 was it's actually a really good cash flow business because there's not a lot of places to invest new money. So they're just going to keep either buying back shares or returning money through in the form of a dividend. I think that still remains to be the case for a company like Las Vegas Sands. The question from an investor perspective is is the eventual high, whether that comes in or recovery in the business, whether that comes in 2023 or 2024, is it higher than 2019? Because in Las Vegas, it was much higher. That incremental revenue is going to be very high margin. And so that I would argue that that's where your upside is in the stock is this there being just a flood of business going into Macau. I think that will eventually happen. Like I said, I don't know exactly when it will. The market is starting to price that in more.
Right.
And I've been writing about this for 6 months or a year. So some of that has already played out. But I do think there is still significantly more upside. The other thing is a lot of these companies have a lot less risk on the balance sheet than they've had historically because they have sold a lot of their assets to REITs if they're in the United States, um, or they just don't have a significant amount of debt. So the leverage profile is a little bit different than it's
Hmm.
been in the past. So that's another thing to think about. For a company like Las Vegas Sands, really the worst casino that it had was the one in Las Vegas. And the
Right.
other ones spit off so much cash in a normal operating environment, a pre-pandemic operating environment, that you would finance that 100% with debt if you could, because your payback would be like 18 months or 2 years. So
Right.
um yeah, I generally think that there's going to be a big recovery in the regions that they're operating in, and we haven't seen it yet. And the fact that the stock is still down, I mean, the Las Vegas companies are reporting crazy numbers. MGM, I haven't dug into the numbers in full, but BetMGM, their online business, reported higher than expected revenue too. So people are out spending money, doing stuff, and looking for entertainment, and this is a great place to get exposure to that.
If I was to put some frames on this, looking at some past numbers, of course, they cut the dividend off completely when the pandemic happened, which makes sense. But if I were to think about the price for the stock today and look at the dividend that it paid in the past, which was a little more than $3 a year per share, based on the last dividend that it paid, and say that dividend comes back in a couple of years,
Hmm.
I would lock in a 5% plus dividend yield at today's stock price with 50% upside in the stock price just to return to its pre-pandemic levels. That sounds like some pretty good upside to me.
Yeah, and one way to play this too is just to buy a basket of these companies.
Yeah.
I own, I believe it's Melco, Wynn Resorts, and MGM Resorts. Add
There
Las
you go.
Vegas Sands into that. I think that's a good way to get exposure, and you don't have to pick which one is going to be the winner because this is a tailwind for the entire industry. Any final thoughts here, Jason? What'd you learn today in the last 24 hours from earnings season? Anything?
So I learned that we've still got a lot to learn about Tesla and the impact of its price cuts
Yeah.
and like where it's going to fall on that axis between supply and demand, and is it going to thread the needle or not? And is this inventory build, is it a smart proactive move, or is it they got ahead of where demand's going to be? We're going to find out a lot. We're going to learn a lot about Tesla in 2023.
Absolutely. Look at the inventory numbers and look at the unit economics, because I think that's gonna tell you everything you need to know. Well, thanks for watching. Jason and I will be back here on YouTube and on Twitter, so follow him at the Smattering Show on YouTube. Subscribe here to Rive Investing. Thanks for watching. We'll see everybody next time.